Silver just crashed from 91 to 85. $6 gone today. And if you're sitting there watching your portfolio bleed, your first instinct is probably to panic, to sell, to think the rally is over. I need you to stop, because what I'm about to show you is going to completely change how you see this crash. By the end of this video, you're going to understand exactly why silver crashed, and who did it, and why I believe this is one of the best buying opportunities we've had in months. I was going through the data last night, and I found something that stopped me in my tracks. The CME, the exchange where silver futures trade, stopped trading yesterday. They halted the entire metals market. Gold, silver, copper, natural gas, everything shut down mid-session with no warning. Just stopped. And the explanation they gave was technical issues. I don't buy it. And by the time I'm done walking you through the data, I don't think you will either. If you're new here, welcome. This is the hidden economy. We cover silver and gold with raw data, no fluff and no panic. If that's what you need right now, hit subscribe, hit like, and hit that hype button because it directly supports the channel. This week needs to be covered. Let's get into it. Let me start with the pattern because once you see it, you cannot unsee it. December, last 2 days of the month, silver was trading at $83. Out of nowhere, it crashes to $70. $13 wiped out in 48 hours. I remember watching it happen. No fundamental reason, no supply change, just a sudden violent move down right before the month closed. People panicked, people sold. And then January started, and silver recovered everything. January, same thing. I watched silver run all month, hit $121, the all-time high. And then in the final 48 hours, it crashed from $121 to $70, $51, a 42% drop in days. I got messages from people saying they were done with silver forever. And then what happened? February started, and silver ripped right back up all the way to 91. Now February, last day of the month. And what's happening right now? Silver crashed $6, almost 7% from the high. 3 months in a row, December, January, February. Right at the end of the month, silver gets hit hard. And the following weeks, it rips back. And every time the crash happens, right around futures expiration. That's not a coincidence. Once is random, twice is suspicious. 3 times at the exact same point in the cycle. I see a pattern. And when I see a pattern this clean, I stop looking at price and start looking at who benefits. Because somebody gains when silver drops $6 in a single session. Short sellers gain. The people who need to deliver silver at silver expiration gain because the metal they owe is now cheaper. And the CME itself gains because a lower price reduces the incentive for buyers to demand real metal. When you map out the winners, the motivation for these crashes becomes obvious. I was up late last night going through the mechanics of how this works, and what I found made me angry. At the end of every month, futures contracts expire. When a contract expires, the person holding it has to make a decision. Either roll it forward to the next month or stand for delivery. That means you're saying, give me the physical silver, I want the real metal. The problem hit me hard when I saw it. Over the last 3 months, more and more people are demanding real metal. In February alone, 24.8 million ounces were moved through COMEX. Real metal leaving the vaults and registered silver in the COMEX vaults has dropped from over 150 million ounces to 87 million. The vaults are getting lighter every single month. Picture this, end of the month. More people want delivery than there are sellers willing to deliver. You don't have a price crisis. You have a logistics crisis, a matching crisis. For every buyer who wants physical silver, you need a seller who has physical silver to give them. And when the numbers don't add up, someone has to step in. Now, yesterday gets very interesting. I need you to really focus here. The CME halted trading across all metals. They said technical issues. But think about the timing. We are at the end of February. March 1st, notice day is tomorrow. March is a major month on the futures calendar. The open interest in silver has been abnormally high for this expiration cycle. Way more contracts than normal for this time of month that haven't been matched up yet. And in that exact moment, with all of that pressure building, they decide to shut everything down. I went back and looked at previous exchange halts to see if this is normal. It's not. Metals halts at the CME during expiration week are extremely rare. And the fact that they halted everything, not just silver, not just gold, everything tells me the problem was systemic. It wasn't one contract causing issues. It was the entire system under pressure. Now, I can't tell you with certainty what happened behind closed doors. Nobody can. But I've studied how these markets work. I've read accounts from people on trading desks during these situations. People who literally sat on the phone trying to match orders during expiration. And here's what happens when there are more buyers than sellers at expiration. Let me walk you through how I believe this actually works. Because once you understand the mechanics, everything about these crashes clicks. The exchange picks up the phone and starts calling participants. They ask sellers to step up, tell buyers to wait, promise them their metal next month. They work through the list one by one. The impatient buyers get talked into rolling their contracts forward. The patient ones get promises of delivery in 30 days. Once enough buyers agree to wait, trading resumes. But think about what just happened. The buying pressure I was watching build all week is gone. The only people left are sellers, and sellers push price down, snorts hard. I know some people will say I'm reaching that this is just conspiracy talk. It's not. These are market mechanics. How futures markets have always worked when buyer demand exceeds available supply. The exchange's job is to maintain an orderly market, and when the market can't match buyers with sellers, shutting down I is the orderly response. But the result for you watching the chart is a crash that looks organic when it is actually manufactured. I watched what silver did yesterday in real time. Before the halt, it was already dropping. The halt happened, and after the halt, silver continued selling off. Gold was up $20 on the same day. Gold dipped too, dropped about 5% to around 51.30, but gold recovered back to 51.75. Silver took a similar dip, but didn't recover the same way. Gold bounced back, silver stayed down. Think about that for a second. Gold up 20, silver down over $2. On any normal day, gold and silver move together. I've checked the correlation for months. It's above 8. They almost always move in tandem. So, when I see gold rally $20 while silver gets hit for 2 on the same afternoon, I know something else is going on. Same market, same macro environment, one exchange. If this was a real move driven by fundamentals, both metals would go in the same direction. The fact that gold rallied while silver got hammered tells me this was targeted pressure on silver during the most sensitive time of the month. When I put this together, it clicked instantly. Silver is the metal with a delivery problem. Silver is the metal where registered inventory dropped from 102 million to 87 million in 2 weeks. Silver is the metal where Wells Fargo just delivered 228 contracts in one session. Gold doesn't have the same delivery pressure right now. So, of course, silver is the one that gets knocked down because silver is the one where the matching problem exists. And here's the thing that really made me sit up straight when I was going through the data. This exact same thing happened on Black Friday. The market got halted. Silver dropped. And the explanation was the same. Technical issues. 2 halts in recent months, both at critical expiration periods, both followed by silver dropping hard, both with gold moving in the opposite direction. I'm not saying the market is rigged in the way that some people throw that word around. What I'm saying is that the structure of the futures market creates these situations by design. When you have a system where paper promises outnumber physical metal by a massive ratio and delivery time comes, the math doesn't work. And when the math doesn't work, the exchange has to intervene to keep things orderly. That intervention is what we see as a crash. It's not a natural sell-off. It's an engineered cool down to prevent something much worse, a default, a moment where someone says, "Give me my silver." And the vault says, "We don't have it. That hasn't happened yet." But the pressure is building every single month, and these end-of-month crashes are the relief valve. Now let me show you why this crash doesn't change anything about the bigger picture, because what comes next matters most. Silver's 50-day moving average has been climbing for 9 straight months. 9 months without a single downtick. Every crash, every shakeout, every monthly dump, the 50-day moving average kept going up. Every single dip over the past 9 months has been temporary. The trend absorbed every punch and kept moving higher. I pulled up the vault numbers. COMEX registered silver is at 87 million ounces. 2 weeks ago, it was over 102 million. 15 million ounces gone in 14 days, and this crash didn't add a single ounce back. Shanghai is still trading silver above $100. The premium over international spot is still massive. Chinese buyers are still paying more than anyone else on the planet for physical silver. That demand didn't disappear because the CME halted trading for a few hours. One more that should make you think. Wells Fargo just delivered 228 out of 229 contracts in a single day. BNP Paribas, HSBC, jpmorgan, Goldman Sachs, all on the receiving end. You think those banks stopped wanting silver because the price dropped 6? They didn't stop and think about what just happened. The price dropped. But nothing in the real world changed. Not a single vault report or delivery number moved. The only thing that changed was the number on the screen. Now, I want to show you something that changes. This entire picture, I found a jpmorgan report that almost nobody is talking about. It got buried inside a mining research note. They ran scenario analysis on where gold reaches equilibrium under different monetary outcomes. And the range they came up with is $5,900 to $9,300 per ounce. I need you to hear that number again. jpmorgan, the bank that literally makes markets in gold. Let me put the 3-month pattern in perspective because I think we have the most important framework for understanding silver right now. December crash, 83 to 70. Silver was back near the highs by February. January crash, 121 to 70. Silver recovered in 5 weeks. February crash, down $6. If the pattern holds, and I see zero reason for it to break, silver recovers and pushes higher into March. But what catches my eye is that each crash is getting smaller. December was $13. January was $51 from the all-time high, but it started from a much more extreme level after a parabolic run. February so far, only $6. Selling pressure is weakening, and the dips are getting shallower. Buyers are stepping in at 85 instead of waiting for 70. I think the answer is simple. After December, people who sold the bottom at 70 and watched silver rip back up learned their lesson. After January, even more people learned it the hard way. The people still holding silver right now have been through 2 brutal shakeouts. They've seen the playbook, they know how this ends, and they're not selling this time. That's why the crash is only $6 instead of 13 or 51. The weekends are gone. Look at the lows. December bottomed at 70, January bottomed at 70, February so far has bottomed around 85. The floor is lifting. In December, you could buy silver at 70 if you were brave enough. In January, 70 again. But in February, the lowest price was $15 higher. The discounts are vanishing. The people selling into these crashes are running out of ammunition. There's a level where the physical market won't let silver drop. Because at that price, every industrial buyer, every bank, every refiner steps in and buys everything available. That level was 70 in December and January. Now it's $15 higher. I don't. Maybe it dips to 83 or 82 first. Maybe it bounces from 85. Markets don't move in straight lines. But I do know the trend. And the trend has been up for 9 straight months without exception. Now, let me tell you what I'm watching for March, because the next few weeks could change everything. Here's exactly what I'm watching. Support is right where we are. If this level holds and silver starts bouncing, the dump is done. The pressure is off, and the next leg up begins. If support breaks and silver drops to 80 or below, then I need to reassess whether this correction is deeper than the pattern suggests. I'll be transparent about it, and I'll show you either way. But I'm not focused on support. I'm focused on 92, the last major resistance before $100. Silver has been building toward this level for weeks. Every rally gets closer. Every pullback holds higher. And I believe that when silver eventually breaks 92 and closes above it with conviction, the path to $100 is wide open. Why does 100 matter beyond the round number? Because at $100, silver becomes mainstream news. CNN picks it up. Bloomberg runs it as a lead story. Your coworker mentions it at lunch. Retail investors who've never looked at silver suddenly want in. That wave of new demand crashes into a market that already can't meet existing demand. And if you think that sounds extreme, I've watched this play out with other commodities. Once mainstream coverage locks onto a shortage story, buying pressure doesn't come gradually. It comes all at once. With 87 million ounces of registered silver and falling, there is no cushion. The system absorbs the new demand by pushing price higher, much higher. Now zoom out with me, because this is where it gets dangerous for the short sellers. Every piece of the puzzle is lining up at the same time. Pattern says recovery. Vaults say drain. jpmorgan says the floor is in, and March 1st notice day is tomorrow. If we see demand anything close to February, when 24.8 million ounces walked out, I think registered silver could drop below 70 million by mid-March. We haven't seen that level in this cycle. The people demanding metal in March are the ones who just watched this crash and bought through it, not weak hands. People who've seen the playbook 3 months running and are using it against the system. Let me tell you what the risks are, because I always give you the risks. Risk number 1, margin hikes. When silver moves fast, the CME can raise margin requirements and force traders using margin to sell. We saw this in January. It causes real damage in the short term. If it happens again, silver could drop another 5 to 10% from here. But every margin hike in this cycle has been followed by a recovery, because you can raise margins all you want. You can't create silver that doesn't exist. Risk number 2, March disappoints. If fewer people demand metal than I expect, the urgency fades temporarily. That would hurt the short-term thesis. But even a quiet March doesn't fix the underlying deficit. World uses more silver than it mines. That gap doesn't close because 1 month is slower. Risk number 3, the pattern breaks. Maybe February's crash goes deeper than December and January. Maybe 85 doesn't hold. If that happens, I'll tell you, I don't hide from bad data. But right now, sitting here tonight, going through everything I can find, everything says this is a buying opportunity, not a reason to run. So where do I land after looking at everything tonight? Silver crashed from 91 to 85. The CME halted trading during the most sensitive period of the month. Gold went up while silver went down 3 months in a row. Same pattern. And silver pushed higher each time. I've been refreshing the vault data every hour, checking Shanghai, watching every notice that posts, and nothing has changed. Not one number. The direction's still up. If you've been watching this channel, you know what I've been saying. I believe silver breaks 92. And when 92 breaks, 100 follows. This crash doesn't change that thesis. It strengthens it. because what we've seen shows us that these end-of-month shakeouts are designed to reset the market, shake out weak hands, and set up the next leg higher. December did it. January did it. February is doing it right now. Silver recovers. That part I'm not worried about. What I'm watching is how fast. And if March brings the kind of demand I expect with registered silver already at 87 million ounces and falling, the answer might be very fast. Here's my call. I expect silver to get back above 90 within the first 2 weeks of March. I expect it to reach and test 92 again. When it breaks through with conviction, the run to 100 will be fast. Pull up a chart of silver right now. Look at the space between 92 and 100. There's nothing there. Open air. In $100, silver is not the end of the move. It's when the whole world starts paying attention. After 100, everything changes. And I mean everything. The media picks it up, retail piles in, ETFs have to buy physical to back new shares. Mining stocks go parabolic, and the supply that was already insufficient becomes nowhere near enough. I believe we're heading toward that sequence, not tomorrow, not this week, but over the coming months, as every new number confirms what we already know, the people crashing silver at the end of every month are not doing it because silver is weak. They're doing it because silver is too strong. They don't care that silver is at 85 or 91. They've accepted the price going higher. What they can't accept is how fast it gets there. If silver was naturally going to fall, they wouldn't need to intervene every 30 days. They do it because without intervention, the price would be at 100 already. If you haven't watched my last 3 videos, go watch them now. I covered the Shanghai explosion, the China versus America civil war, and the Wells Fargo delivery bombshell. Links in the description. Together with this video, you now have the complete picture. The data, the geopolitics, the deliveries, and now the manipulation pattern. Drop a comment and tell me, are you buying this dip or waiting? Have you noticed the end of month pattern before? I want to hear your take. And share this video with anyone who holds silver and is panicking right now because they need to see this data before they make a decision they regret. This is the hidden economy. Don't panic. Stay sharp. Stay stacking.